Are you holding on to your losing stocks? If so, you may have get-evenitis. And today, we have your medicine. What's up, y'all? I'm joined today by my good friend and co-host for these Friday editions of the podcast. We got Marshall Johnson here with me.
Hey.
And this is our opportunity to cover a weekend reading article with you, as we do almost every single Friday. Well, one thing we do every single Friday is we do send out an email every Friday.
Yes,
now,
sir.
We don't always pick out an article from one of those 4 articles we send out to you and do a podcast on it. But 90% of the time, but other 10% of the time, Marshall and I just get really excited about a concept and we want to share it with you. We may gloss over one every once in a while, but this week we are covering a weekend reading article with you. In that email, you can sign up at retirewithpurpose.com. And when you do, not only are you going to get those 4 articles on trending topics in the financial planning space, all designed to help you make better decisions in every area of your financial life. But you'll also be included with special invitations to webinars and white papers, book giveaways, all kinds of great stuff. Again, sign up at retirewithpurpose.com. This week, we are going to highlight one of those articles, and we are highlighting an article from the Bell Curve blog. It is also Blair, I can't hardly say her full name, let alone the name.
Let alone the first name.
So BlairBellCurve.com. So it's written by Blair, and Blair, I apologize for this. Duquesne.
Duquesne?
I mean, I might have nailed it. But
Duquesne?
This is a very relevant article, and I guess initially,
Great article.
I was really attracted by the name. I like it when people come up with new names
Catchy
for
titles.
things that just kind of catch my eye. And this was one of those. It is titled "Get-evenitis."
Get-evenitis. Love it.
Yeah.
You know, sometimes an article, you just have to read an article when it comes across your desk, and it's entitled Get-evenitis. Because I want to know what get-evenitis really is.
I know. Now I'm curious. I want to know more about get-evenitis. And then when I got into the article, I realized this is something that is a very big challenge for a lot of the folks out there and a lot of individuals that we'll meet with, especially do-it-yourselfers. I know we have a lot of do-it-yourselfers that listen to the show, and this can be a big challenge when you're doing it yourself. You don't have a sounding board. You don't have a voice of reason. You don't have somebody to say, hey, you should probably sell that.
Yeah, I think anybody that's ever traded a stock or Bitcoin or anything in their life has been faced with this sort of situation.
Yeah, there's a lot of people in those in microcap stocks. You see this a lot. You see it in microcap stocks. You see it in some of those more obscure cryptocurrencies. Friends that I'll run across from. They're like, "Well, it's at $1. I don't know. It keeps going down, but
penny stocks
someday it's going to go back to $1." Yeah.
Yeah, they get pumped up to $3, and it's like, oh my gosh, and it's back down to 57 cents.
Yeah, but it also happens to large cap stocks too.
Oh yeah, anything,
big names, and GE is one of the examples that's listed out in this article. So the article is really focusing on some behavioral biases that we tend to have as humans. We're all humans. We have behavioral biases, and the one that this article is focusing in on is something known as loss aversion.
Yeah,
and
probably the behavioral trait that's most detrimental.
Yeah, right. We want to avoid losses more than we want to achieve gains. Losses hurt twice as bad as gains of equal value, right? And this was, you might know this as prospect theory, which was an introduction by Kahneman and Tversky back in 1979. And it's something that has really helped me, as an investor, become a better investor and a better decision maker as well. I often think about what all my biases are and try to overcome those things with a lot of the strategies and techniques that have been talked about by some of our past podcast guests and a lot of the books that I've read as well, because it's potentially these behavioral biases, and I think this has come to the forefront over the last 20 years, have become the biggest risk to, I think, the majority of investors is just simply our behavior, which is why when we design our planning framework, when I'm sitting down with a couple and going through the framework, I'll share with them that retirement is largely psychological, meaning that the mistakes that are made in retirement are largely psychological, and we
behavioral.
We can control those bad behaviors through good planning that you understand. We assign dollars to different roles, to different purposes, and I think most behavioral mistakes happen because people are just investing, right? They don't really have a plan. They just have a portfolio. Maybe you're following a 60-40 stock mix. You're just kind of a buy and hold investor. Maybe you're a stock picker. Maybe you're day trading. You're just focusing on this investment portfolio that's supposed to solve all your goals, rather than really carving out sections of that portfolio as a whole to say, this is for my income, this is for my emergencies, this is for my long-term income needs, midterm income needs, short-term income needs, this is for my kids. If we approach things from leveraging a framework, that framework will help us overcome a lot of these behavioral biases. Now, back to this article, this one is focusing on prospect theory. It's focusing on loss aversion, and it's focusing one very relevant area for a lot of investors right now, which is the reluctance to sell an investment that's trading below its original price. Yeah. Well, I bought it for $10. Now it's $8. I can't sell it. Well, that is what's known as get even itis.
Yeah, I thought for sure this was going to be a revenge piece, right? It's kind of like your daughter. You told me a story the other day, right? She pinched you, and you're like,
she pinches.
You like pinched her back, and all of a sudden she
just so she
got
knows.
so upset. That was get even itis, right?
Yeah, I can't do it again.
Yeah. Well, good thing she's super cute.
The purchase price of an investment should be irrelevant to the investment decision that you have today. The article, the author says the prior decision is a sunk cost. I think this is where things get a little muddy in the behavioral finance world. Sometimes you go, wait, is this a sunk cost fallacy? Because sunk cost fallacy is really close to loss aversion, right? With loss aversion, we want to avoid the losses. Basically, if we just lay it out very simply, right? We don't care as much about the gains as we do avoiding those losses. Sunk cost fallacy is, well, I paid X for it. I've lost those dollars, and they kind of go hand in hand, right? Yes, that is a sunk cost that you had, and it should be irrelevant to your decision. But you have two things going on here. One, you don't want to lose, and two, you don't want to be wrong.
Yeah. So what we're seeing right now is we've seen losses. Let's just take NASDAQ stocks, for example. So let's say somebody's on the fence. They know they've been heavy in tech stocks for the last 5-7 years. Now they know they need to rebalance away from tech, maybe. The article says here, the choice of how to invest $1 today should not be held hostage by the decision made in the past. They're unwilling to let go of Amazon or Netflix at these valuations today, even though they know that they should make an adjustment. Yeah. So they're holding off on let's wait for it to come back.
Or there might be a better place to reallocate.
Or things have changed.
Yeah, and we see this with individual investors. We see this with financial advisors. We see this with people that are investing in real estate, right? We want to hold on to those things. We want to get back to even. We don't want to be wrong, and I wonder, is this an ego thing? Is it is it a technical knowledge thing? Right? It's like, why do we do this to ourselves? Why do some have no issue selling at a loss and reallocating to something else? And why do others, I'm holding on to this thing to the bottom, right? Why is that decision to liquidate so much easier for some than it is others? And I think it's a combination of these two things. So for me, I just did this recently, and the article talks about tax loss harvesting a little bit. I tax loss harvested a chunk of my growth assets, and with those growth assets, I didn't even think about it, right? I just said, I'm going to liquidate and I'm going to reallocate some index funds, and then after 30 days, avoid the wash sale rule and jump back in. And I was able to generate some losses that I can use for tax reasons. And so it really does depend on where the assets are held too. If you're looking at this from a tax perspective, right?
Right.
This whole
it doesn't matter inside of an IRA.
Aversion. Yeah, the get evenitis is 100% applicable when it comes to an IRA, Roth IRA, 401k, right? Because because the taxes aren't a consideration at that point. But if it's in an after-tax account like it was for me,
but it
was easier for me to sell because I had that balance, right? I had the balance of, well, I can go ahead and sell and I can reallocate over here, generate some losses. And yet I had the same conversation with some clients who've had a real challenge liquidating those positions when they're down and reallocating temporarily someplace else into index funds or otherwise so that they could generate those losses. They just don't want to pull that trigger.
Do you think it's because you've seen investments go to zero?
I mean, I have, right? I mean, I've got one
Muni
bond in
bonds.
mind that went to zero. I have a couple equity positions that went to zero back in the early 2000s, right?
But looking back at that bond, there was a moment where you were like, okay, I could sell this for 50 cents on the dollar. And you were like, no.
There's no way this is going
to zero. And then it did.
Yeah.
So now that prior experience may now give you the momentum to actually follow through.
Because I think I learned a lot of this from my father as well. When I think about this, I think about my dad. He just recently did it, with some real estate. So he's made most of his money in real estate over the years. And he likes to buy and sell homes. He kind of treats them like art, right? They're almost collectibles. Like he holds
it's like a hobby.
Yeah, he trades homes, moves around the country for a while. It's a hobby for him, but he's done very well financially in it as well, but not every single time. So recently he sold a property, which if he just held out a little bit longer, he would probably, and he admittedly said this last weekend, I would probably be able to eke out a gain at the end of the day if I just held on to it. But I know this other property is a much better investment right now.
It's going to be gone.
He's going to be able to buy it for a great price and generate a pretty significant yield in the way of rental income from it as well, over and above what he could from his other property. So he goes ahead and drops the price, takes a hit, doesn't get a gain out of that other property so that he can buy something he knows will be a better investment. And I think you're right, Marshall, but I think it's twofold. I think there's ego that's built into that, right? Where, he's able to just let go of that ego. Wow, this isn't my long-term track record, right? This one property isn't going to be telling me whether I'm really good at real estate investing
his
or not.
Scorecard. It wasn't.
But you don't see with stock investors. I see quite often. It's like the whole scorecard is one position, right? And you kind of lose track of the big picture. And I think this is what's, for me, I have the same tendency, I think, when it comes to equities. When I was trading my own portfolio, now I have professional money managers that are taking that emotion, that ego out of it. And they're going, hey, we need to, that's just an example, we need to sell Coke today and buy Pepsi, right? And maybe we take Coke as a loss and we buy Pepsi when it's actually an elevated price. It's like the average investor isn't going to have the discipline to execute on that strategy and be able to drop their ego, take the emotion out of it, and just look at it from a purely technical standpoint. Which is the better decision? Which is the better option for me to be holding on to?
Well, and do you think with advisors there's that ego as well? Like,
I think it might be bigger with advisors, right? And portfolio managers have it as well. I think that's one of the things you need to screen for when you're looking at portfolio managers. Is this someone that actually has, look at their track record. Have they ever sold a position at a loss, right? Because that shows discipline. Every portfolio manager should be selling a position at a loss at some point during time because they should be actively looking for better opportunities.
Especially this year, right? Think about all the stocks. The PE was 47 and now it's 23. They may like positions out there today. There's more attractive valuations on positions. They can upgrade positions in their portfolio, even if they have to sell something at a loss that they just purchased last year at a much higher valuation.
I see this as a real challenge for younger advisors as well, because we're kind of trained with this buy and hold mentality. The textbook tells us that we should just hold on. It'll always come back. With more experience, I think you get yourself out of that. But with an advisor that said, hey, this is the right portfolio for you. Now it's down 10%. To come back and have that conversation and say, hey, this is not where we should be right now. We need to reallocate somewhere else. It's not the advisor's fault, but they feel like it's their fault. But the reality is economic conditions may have changed, right? Economic conditions may have changed, and that advisor needs to drop the ego. They didn't have a crystal ball, reallocate someplace where the client has a better opportunity for long-term returns.
Yeah, I think it's a really dangerous environment for new retirees or those that are about to retire, because it's been such a strong bull market. We've been blessed with significant returns. Everything's looking great, and it's giving you that false sense of security about the markets and volatility. And now we're starting to see volatility tick up. I think it's a really good time to reassess your true risk tolerance. Go through the can discussion. Do we have the capacity to take risk? Do we have the attitude for risk? Do we have the need for risk? And go back through that to reassess how much risk you're really taking today.
Yeah. Well, and before I want to dive into a little bit of how do you actually look at this from a broader perspective like that. But first, I think the GE just offers a great example, right?
That's
GE
great.
been around for a while. In GE stock, if you would have purchased GE stock back in March of 2017, you would have paid $240 a share. The price immediately started to decline. By the end of the year, it was trading at $145 a share, about a 40% loss in 9 months.
Woo!
And if you held on to that today, you'd still be down around 60%, right?
So to look at that person could have said at the end of that 2017 period, well, I don't want to sell GE because it's down 40. It's a big blue chip name. It's so well respected. It was once one of the largest companies in the world. It'll be back. But now that person's still down.
Yeah, and in the interim, there's probably a better place to allocate those assets. Sometimes a better place is cash, right? Sometimes a better place is cash to buy back at a better price. And there's a lot of ways to look at this. But to go back to what you were saying, Marshall, I think when we're doing this analysis, we have to start where we should always begin, and that is the purpose. What are you trying to accomplish at the end of the day? And I'm not talking about with that investment portfolio necessarily, but what are you trying to accomplish in your life? Is that one position causing you anxiety, keeping you up at night, not able to sleep? You're thinking about it over the weekends. You're thinking about it when the grandkids are playing. You're looking at your phone when you should be talking to your wife over dinner. And is that what's going on? Well, maybe it just makes sense to sell it and reallocate and do something else. Maybe you have a broader portfolio and you're getting ready to retire. Maybe it's a little down right now, but you want to retire when you want to retire, right? You want to retire in 6 months. You want to retire in 12 months. And so what? Maybe you're going to be down a little bit over the last few months, but over the last decade, you've been crushing, right? So you didn't really take a total loss. You just took a little bit downturn over the last few months. And by reallocating and moving those assets somewhere else, you're able to actually ensure that you're going to be able to retire when you want to retire, right? That might be worth it. So looking at what you're trying to accomplish, I think a lot of the families we're working with, that's what they're doing. They're in a position where they want to retire. Maybe they're a little uncomfortable with the risks that they have. They want to de-risk their portfolio, but then we're always looking at the market. The market might be flying, and you're going, yeah, but I don't want to lose
I don't want to miss out.
5 or 10%.
I don't want to miss out.
Maybe the market's down 10%. You go, yeah, but I'm just going to wait till it rebounds, right? And that may not be the best move for you. And how do you actually analyze what the best move is? Well, if it's in an IRA or Roth IRA, it's really just going to come down to a lot of personal preferences and goals and what you're trying to accomplish at the end of the day. But if it's in an after-tax account, there is further analysis that you can do. And I really love doing that analysis.
Yeah, to reiterate the point that you just said, if you're worried about this sunk cost fallacy or this loss aversion of selling something while it's down, if it's in an IRA, the price doesn't matter. Like if something's changed, move on, get in, get out.
Yeah, the price that you paid doesn't
matter.
It's irrelevant to the current economic conditions and what's going on with that particular investment right here, right now, and what's going on in your life for that matter. If you hold these assets in an after-tax account, that's where the analysis gets a little bit more fun. I worked with our team here recently to review a strategy that we were putting together for a client, and this was an individual that had some positions that were moderately appreciated. We're a little concerned about liquidating some of those positions and incurring taxes. So they didn't want to liquidate, incur taxes. However, they did want to de-risk and they wanted to reallocate someplace that was more in line with their goals. And so, well, let's weigh this, right? Let's take a look at what the tax impact is from a capital gains perspective. So we went through, did the analysis, and said, all right, this is the question: how much does a portfolio have to move for this to be a great decision? How much does it have to go to the downside for this to be a great decision that you paid a little bit of taxes? it's good to pay taxes because we pay taxes when we make money. And so we looked at
it's good to reiterate that.
How much is in the 0% long-term capital gains tax bracket? How much is in the 15? How much is in the 20? How much is in the 20 plus the 3.8% Medicare surtax? Take that tax that you might actually have to pay and put that over your portfolio size. And
or if you're talking one stock, how much does a stock have to fall? $2?
Yeah, in like this instance, I think it was like 2-3%, right? The market didn't have to move that much to the downside to make paying the taxes a much better deal than holding on to it. And they're very happy that they did that today. They're very happy that they paid some taxes and reallocated to some places that didn't experience the type of volatility to the downside that they would have had they held on to those things. So in the end, bottom line, waiting for an investment to get back to even before you sell it, useless exercise.